The state of the auto loan market has just gotten worse. Now, let me explain. For the better part of 2023, we've been discussing the state of 2023 auto loan delinquencies and repossessions. You see, over the last couple of years, more and more Americans have been spending more and more money on their cars. In fact, as of last night, the average transaction price for a new car was $47,899. Which is actually showing some pretty nice downward trends for 2023, but is a still far cry from where we were pre-pandemic. And currently, the average car payment is $729 per month for new cars and $528 for used. And on top of all of this, national outstanding auto loan debt has been increasing month after month, with some of the more recent data showing the current U.S. outstanding auto loan debt has surpassed $1.5 trillion. And granted, in recent months, car prices have stabilized, at least a little bit, and in some cases, car prices have even gone down depending on the make and the model. But currently, interest rates are incredibly high with no real plans of going down anytime soon, and that's creating a whole issue in itself. And according to Experian, and you can see here with this graph provided by NerdWallet, the average APR for a subprime borrower, so someone with excellent credit, is 5.07 for a new car and 7.09 for a used one. While for a deep subprime borrower, so somebody with extremely poor credit, the average interest rate is sitting at 14.18% for a new car and a whopping 21.38% for used. And I do want to take a moment to just emphasize how extremely expensive the average car is today compared to the average income of the average American. Because I feel as though the United States has this culture surrounding buying new cars and carrying a car payment. And so because of this, many car buyers, especially younger and first-time car buyers, don't really understand the gravity of the debt that they're getting into because of the fact that $500, $400, $700 car payments are pretty normalized nowadays. And because of this, the unaffordability and just how expensive cars are doesn't really sink into these buyers until it's too late. Based on personal finance principles, a car payment shouldn't be more than about 10% of your monthly take-home pay. Sometimes you'll also see the figure of 20% thrown around, which may account for not only the car payment, but also insurance, gas, maintenance, and things like that. But for this example, we're going to stick to the car payment alone, which should not exceed 10% of your monthly take-home income. The average U.S. salary is about $58,000 per year. And this means that the average take-home salary in the United States is about $45,000 per year. Now, obviously, this depends on where you live, as well as a slew of other factors, but we're going to use this average for this example. And this would mean that the average American is taking home about $3,750 per month from their job. Keeping this 10% rule in mind, the average American should be spending no more than $375 per month on their car payment. And yet the average car buyer is spending $729 per month for their new car and $538 for their used. In the case of a new car, this is almost double what the payment should actually be. And in the case of a used one, it's over 45% more. And remember, these are all averages. Of course, there are car buyers that are spending less than these numbers, and there are income earners that are making more. But based off of the averages that we see in the market, the average car should cost about $375 per month based off of how much the average American is earning. And that just simply isn't the case. And what the average data shows us is that the average American is actually spending substantially more. And this doesn't even begin to take into account other forms of consumer debt, which have also skyrocketed in the last few years. The reality is the current state of the car market and how much people are paying for their new and used cars, what their monthly car payment is, it simply doesn't add up and it isn't sustainable. And it does seem as though things are finally beginning to come to a bit of a head. Because according to a recent report, car owners are falling behind on payments at the highest rate on record. According to Fitch Ratings, which is one of the big three credit rating agencies here in the United States, the amount of borrowers that are at least 60-day delinquent on their auto loans has reached 6.11%. which is the highest amount that Fitch Ratings has ever seen since they started recording this data in 1994. And now the delinquency data is officially higher than not only the dot-com bubble in 2000, the housing crash in 2008, but also pre-pandemic in 2019. And as you can see here, that since 1994, this is the highest percentage of subprime borrowers that are at least 60 days late on their auto loans. And according to Margaret Rowe, the senior director with asset-backed securities at Fitch, subprime borrowers are oftentimes the first line of where we start to see the negative effect of macroeconomic headwinds. And what does that mean? It means that whenever it comes to an economic shift, the weakest links are the ones that fail first, and they begin to set the trend that other segments follow. And in the case of this specific study by Fitch, we're talking about subprime borrowers, so people that had poor credit, high payments, high interest, and they now dug themselves into a hole that they're having trouble keeping up with. And as a result, they are the first ones to go delinquent on their auto loans because it's relatively safe to assume that they probably have some of the worst deals in the auto loan industry and some of the highest payments, at least in relation to payment versus purchase price ratio. And a rise in subprime delinquencies can oftentimes be an indicator that other types of delinquencies may follow, even outside of the subprime borrower category. And I want to emphasize that according to this data, which was back in September but was recently released this week, it doesn't even take into account student loans, which have resumed this month. According to the Federal Reserve Bank of New York, the average monthly payment for a student loan borrower is $393 per month. That is over 10% of the average income earner's monthly take-home pay. And so the delinquencies that we have been seeing up until this point are delinquencies that have been going into effect with changing economic times, but with student loans still on pause. And now the student loan pause has officially ended, and now this $393 per month payment is getting paid towards student loans rather than sitting in borrower's bank account. And I believe that it's safe to assume that as a result, delinquencies for not just auto loans, but across any type of debt is expected to rise because student loans are resuming. Not necessarily directly because student loans are resuming, but because of the fact that people took on debt without taking into account their student loans, and now they're really having to pay for that decision. Now, we can't talk about delinquencies without talking about repossessions. According to Cox Automotive, while repossessions are still lower than pre-pandemic levels, they are higher and have increased recently, with repo rates rising steadily between 2021 and 2023. With projections of this continue to rise for the next few years. Which makes sense because repossessions have been historically low because of the pandemic, and over the last couple of years, repossessions have been sort of put on pause, which is no longer the case. And with 60-day delinquencies hitting all-time highs, I believe that it's safe to assume that repossessions will probably have an uptick as well, because typically repossessions occur once a car is about 90 days past due, though it does depend on the specific situation. And as we sit here today in October, many loans are at that point today, but we'll have to wait a few weeks, maybe even a few months, to see how the data trends with repossessions specifically. Though again, I do think it's pretty obvious that they probably are going to be going up. And as far as some recent repossession data, the Ford F-150 and the Honda Civic are two of the most commonly repossessed vehicles, the F-150 being the most repossessed truck and the Honda Civic being the most repossessed car. And according to 2022 data, yearly repossession rates are 65% of yearly new car sales. This means that for every 2.4 cars sold, one existing vehicle on the road will be repossessed each year. The reality is the current state of auto loan repossessions and delinquencies just simply doesn't look good. Between higher car prices, higher interest rates, higher cost of living, the market has been trending in the wrong direction. And given that the current job market is lofty and a bit questionable, interest rates are expected to stay high, and student loan payments have officially begun again, I worry that things are going to get worse. Because like I've said 100 times on my channel, the current debt situation revolving auto loan debt and the amount of money that buyers are spending each and every month on their car payment, it's simply unsustainable. That's the bottom line. And while this could ultimately be good news for the average car buyer who's looking for a deal, because as delinquencies and repossessions increase, demand and supply will also shift with that and prices should go down, it obviously isn't a good thing for the borrowers that do go delinquent, or the institutions that are hit with an influx of delinquencies as well. And the current delinquency data shows that there's a real chance that this situation could get significantly worse in the coming months and in the coming years. But only time will tell. Like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I'll see you guys in the next video.